how about stock-based compensation? Our member says I usually take stock-based compensation and stock issuance out of levered free cash flow and add any buybacks and dividends. What are the pros and cons of that method?
Okay, thanks for this question. I know where this method came from, and it's not rooted in actual business management. The problem with this method is it's not a real financial metric. If you're worried about stock-based compensation as an expense, as a business expense, that's what GAAP, or if it's business that reports outside of the United States, IFRS accounting principles are for. GAAP net income, IFRS net income accounts for stock-based comp as an expense. So you don't need to make a new financial metric that subtracts SBC from free cash flow. Free cash flow is its own unique profit metric that doesn't need tinkering with. And there's lots of other financial metrics out there that can be used as well to gauge profit and a company's operating efficiency. The most important metric from an operating standpoint is just good old-fashioned free cash flow per share. On a per share basis, that accounts for the stock-based compensation for you as a shareholder of the business. For most retail investors that don't do this for work, investing for work full-time, this subtracting of SBC from free cash flow is a bad habit that developed during the last bear market. And for most investors, it's just a distraction from what you should really be focused on. Just very simple free cash flow per share, or simply learning about businesses and industries and how business models actually work.